Now, Bollinger Bands is one of the technical indicators that can help you make smart decisions, figure out whether you should buy or sell, figure out where you might want to put your stop loss, maybe help you figure out how volatile the markets are. Now, if you ever attended any of our technical analysis classes, you know that we have technical indicators, and we have oscillators, we have bounded indicators. There's all different fields of indicators. But all of these indicators are all based on, or can only be based on, basically 5 numbers: the open, the high, the low, the close, and volume. It is the mathematical formula that is used for these numbers that make one indicator different than the other. Now, Bollinger Bands can be applied in all financial markets, including equities, forex, commodities, and futures. Bollinger Bands can be used in most time frames, from very short time frames to hourly, daily, weekly, and monthly. And that's something to keep in mind, because a lot of indicators don't work well in either non-trending markets or in very short term. A lot of indicators, if you're looking at a 5-minute chart or a 15, don't give you accurate readings because they don't really adjust well in very short term time frames. Now, Bollinger Bands answers a very basic question: are prices high or low on a relative basis? Now, isn't that important to you? Because remember, when you're trading CFDs, or you're trading anything in the short-term market, we don't really care what the actual value is. You know, if you're investing in Apple, say, you want to know what the real value of the stock should be based on what the corporation is doing, based on what its sales are doing, based on its growth factors, its subscribers, everything, because we want a true value. That's for investing. When you're trading, you're only concerned is that price too low and is it going to jump up, or is it too high and is it going to jump down, to fall down today or tomorrow or the next day? We're only concerned with the relative movements in a very short-term time frame. So it's important to us to understand if the price is high or low on a relative basis at the moment. So by definition, price is high at the upper band and price is low at the lower band. That bit of information is incredibly valuable. It's even more powerful when combined with other tools, such as other indicators for confirmation. Now, towards the end of the class, I've actually prepared a little video presentation to share with you to show you how to combine Bollinger Bands with other indicators to put them together in a trading strategy to make a decision. Now, keep in mind, Bollinger Bands are a technical analysis tool that falls into a category known as envelopes or bands. It's one of the tools, or it's one of the few technical indicators that is actually dropped directly over price on a chart. Let me pop up a price chart for us real quickly here. Okay, as you can see on this chart, let's just drop on here stochastics for no other reason. Most indicators go below on the charts. Very few indicators. Oh, I'm not moving averages. I'm not talking about support and resistance. I'm talking about mathematical calculation indicators go directly over price. Bollinger Bands is one of those indicators that actually lays right over top of price on your chart. And it's one of the reasons I like it better than most. And that's because it doesn't take you away from watching price. Because I'm a price action trader. I believe everything is in the price on the charts. Okay. An indicator is basically an interpreter or an indicator. So Bollinger Band is really nice because it is dropped right over the price on charts, so you can get a relationship between the two. Now, Bollinger Band starts out this formula by using a moving average. We start out by dropping a 20-period moving average on our chart. The moving average doesn't tell us much. It's a very simplistic indicator. But this is just a starting point for Bollinger Bands. Because remember I said to you earlier that all indicators can only use a few pieces of data that we have: the open, the high, the low, the close, and volume. Well, moving average uses the close. It's very simple. If you have a 20-period moving average, you take the last 20 closes, add them together, divide by 20. Very simplistic. But it's a starting point for Bollinger Bands. We have to have a number that we start with. And then I said to you, then it takes those pieces of information, those pieces of data, and it's how, or the formula that's used to combine them together that makes one indicator different than another. Well, Bollinger Bands then applies a statistical formula for something known as standard deviation. Okay. And we're going to have to learn tonight what standard deviation is. I'm even going to tell you how to calculate. You'll never have to calculate it. Nobody calculates standard deviation, even in statistics and mathematics, without using a computer. But the standard deviation is dropped on the Bollinger Bands based on the moving average. So here we have our moving average, and his upper line and his lower line are, for Bollinger Bands, 2 standard deviations from the moving average and minus 2 standard deviations. That's what gives us the 2 barriers, or the 2 fences, or the upper or the lower band for the Bollinger Bands. Okay, so now we're going to have to do some mathematical stuff. So let's go back to my PowerPoint. Okay, so Bollinger Bands are typically charted over 20 periods. Some traders make those periods days, other traders prefer shorter term looks and make them hours or minutes. Now, as the name implies, Bollinger Bands are price channels, or bands that are plotted above and below the price. The outer Bollinger Bands are based on price volatility, and standard deviation measures that volatility that's in the market. Now, the nice thing about Bollinger Bands is one of the added features of Bollinger Bands, which we can see very easily visually, is the wider the bands, the more volatile the market. The more contracted the bands are, the less volatility that's in the market. And that little piece of information helps you, because if you're going to enter a market, you need to be understand where you're going to put your stop loss, what your risk management is, how to set your risk reward ratios. The more volatile a market is, the farther away from your entry point do you need to set up your risk reward, because when the market's bouncing high and low with lots of volatility, you don't want to get stopped out of a market just because it's got bounces in it. So that little piece of information is invaluable to all of us. But that's only a side effect of Bollinger Bands. Now, let's get back to standard deviation, because you're all going to hate me shortly. So interesting, in the real world, no statistician will ever calculate standard deviation by hand. The calculations involved are somewhat complex, and the risk of making a mistake is high. Also, calculating it by hand is very slow. So this is why we use computers and spreadsheets. But that's fine. You don't ever have to calculate, but you sure need to understand it. Okay. So standard deviation is a measure of the dispersion of a set of data from its mean. It is calculated as the square root of variance by determining the variation between each data point relative to the mean. If the data points are further from the mean, there's a higher deviation within that set. Okay, you got it now? You all mathematicians, you all learned that? I know. That was very confusing. I'm going to explain it to you a lot easier. But that's the standard statistical explanation. So let's put it this way. In its simplest form, the mean that they talk about is just the moving average. It's the average of the data points. Now, wouldn't you be interested to know that how much the market is moving from the high to the low? And how much this high and this low in this 15 minutes is different from the high and the low in the last 15 minutes. So in investing, for example, you might want to know the mean closing price for the last 20 days or the last 20 periods. What is that? That's a 20 period moving average. So the standard deviation is calculated based on, let's throw the word mean out, and let's put the standard deviation is calculated based on the 20 period moving average. The distance of each data point from the mean is squared, summed, and averaged. Well, let's go back and say the distance of each open, high, low, and close from the 20 period moving average is then squared, summed, and averaged. Okay. So what do we have? We have the 20 period moving average, and then we calculate how far from that moving average is the open, the high, the low, and the close from that period. So to put it another way, variance is derived by taking the average of the data points, subtracting the mean from each data point individually, squaring each one of these, and then taking another mean of these squares. Standard deviation is simply the square root of the variance. So what are we getting with standard deviation? We're getting the variance of each time frame from the moving average. Okay, now I promise that's it. No more mathematical talk. So we start out with the base. The base is the 20 period moving average. The upper band, which is put on above the moving average, is a volatility measure of standard deviation. And we use 2 standard deviations times 2. The lower band is the exact opposite. It's minus 2 standard deviation. So the upper and the lower band are the same distance from that moving average and form that band with the moving average in the center. So we end up with moving average, upper band, which is 2 standard deviations above, a lower band, which is 2 standard deviations minus 2 standard deviations. Again, the wider or the narrower the bands are, the more or less volatile the market is. We got it. Now, the fact is, you'll never have to worry about any of this again because our charts just put it on our charts for us. So here we have the 20 period standard moving average. Okay. But if I want Bollinger Bands, I just click on the Bollinger Bands indicator and it just drops it on my chart. I can turn off the moving average because it's already here. And there I have my Bollinger Bands. Don't ever have to. And if you look at the settings, the automatic default is a 20 period using the close with a standard deviation of 2. You can adjust it any which way you are comfortable with. I just made these darker so you can see them better. And here we have Bollinger Bands on our price chart. Well, that was the easy part. Now you have them on your chart. What are you going to do with them? Now we come to the difficult part. Now, keep in mind the width of the bands or the shape that the bands make, not the width of the band, the shape the bands make doesn't tell you anything. Sometimes they look like dragons. Sometimes they look like space aliens. Sometimes they look like squeaky little worms. There's nothing to tell, no story involved in there. Now, the width of the bands, like I said, will tell you how volatile or contracting the market is. That's important. That's the only piece of information you're going to get out of visually the bandwidth. Now, this happens to be a live chart, and we happen to have a very, very good example of it. One of the most important things we're looking at with bands is called riding the band. The relationship of the upper and the lower band have very little to do. There's no trading signal when it breaks out of the band. There's no anything like that. What we're looking for is the price will stay within this band while the price is moving and the price is trending up or down. We need to look at the relationship of the price to the moving average and its relationship to the upper or the lower band. In an uptrend, we're going to be riding the upper band. In a downtrend, we're going to be riding the lower band. What we're looking for is when price is trending up steadily, price should remain close to the upper band. Breaking out of it, staying above it doesn't mean anything. What we're looking for is rejection. When price is moving up and staying on the band, all of a sudden it tries to push up again towards that outer, and it gets rejected and it can't make that outer band. Okay, tells you that trend action is in trouble. Not that it's over. Okay. Anytime it stays above the moving average, okay, tells you that trend or that movement is still a qualified movement. It's breaking this moving average that tells you that trend is over. So you're looking for rejection, and you're looking for a shift in its change of its relationship. Okay. Now, this is called riding the bands. Price is moving up steadily. It doesn't matter whether we have a red candle, green candle, how high the candles are. We're constantly looking at the relationship of this moving average. Like here, we were in a downtrend. Nice downtrend. Downtrend we could have made some good profit at. But how do you know when to get out of the market? Just because we got a green candle here doesn't mean that downtrend is over. But now, doesn't matter that we got a long green candle here. It broke the moving average. That tells us we should be out of that. We should be exiting that trade that we were in because that downtrend is over. Okay. Same thing in this case. Now, in this case, again, we happen to get a huge candle, but that had nothing to do with the band. We got the rejection of the band here. We got a double rejection here because see here, tried to make it up there, fell back down, tried to push. Okay, it's telling us that trend is over or in trouble. Here, when it broke below the moving average, if you were in this trade, you would have wanted to get out. We also saw that the volatility was increasing dramatically. So you following along with me? So what Bollinger Bands does, it gives you pieces of information about the markets. It doesn't really give you buy prices and sell prices. It really doesn't even give you buy and sell alerts. It gives you market information. It helps you set your stop losses and your take profits. It helps you see the volatility in the markets, helps warn you about, or it tells you how strong or weak a trend is. So there are a lot of ways that we can use Bollinger Bands in our trading. So what do we have? We have three primary uses. Okay. We have pattern recognition, we have reversal signals, and we have trend analysis. So what'll help? It'll help us see double bottoms, double tops. It'll help us see reversal signals by identifying early warning signs of reversal. It'll help us with trend analysis. It'll help detect whether our trend is a continuation or at the end. So there are many ways to use Bollinger Bands, but it's important to note that when the price touches the upper band, that doesn't automatically mean sell. Please do not get that into your head. In fact, take it from John Bollinger himself. There's absolutely nothing about a tag of a band that in or of itself is a signal. Now, we want to watch when price walks the band during a strong downtrend or an uptrend. This means that there are repeated instances of price touching or breaking through the lower or the upper band. That's why you may not want to take action when the price touches either band and might instead prefer waiting for a look for a double bottom or a classic M top or 3 pushes higher. Okay. These are 3 different ways to trade or use Bollinger Bands. I'm not going to discuss them with you because they don't work for our kind of trading. They take way too long to develop. Okay. And it's like watching for head and shoulders. I never see them. You don't see them till you get the third, the second shoulder in. And by then it's taken 2.5 days. Okay. The M and the W pattern are basically head and shoulders inside the bands. Now, the fact is, Bollinger Band also works great when combining with RSI or stochastics. It's like the perfect match. Walking the bands is my favorite way of watching Bollinger Bands. Okay. So just keep in mind, just because price breaks out of the band doesn't tell you anything. But when price is walking up or down the bands, it's when you get the rejection of the band that tells you there's something going on. The Bollinger Bands can also indicate the ends of strong trends. Strong trends cause an expansion of volatility that will cause the bands to initially move apart, meaning the lower band will move down opposite the trend. When a trend begins to wane, the lower band in an uptrend will turn back up, which may be a signal that the move might be over, or at least for a while. Now, volatility tends to be mean reverting. Periods of low volatility are generally followed by high volatility and vice versa. When the bands are narrow, we can call it a squeeze, and it means there's low volatility. But remember, since volatility is mean reverting, the bands will probably expand, signaling a potential for an explosive movement. And there's actually a strategy called the Bollinger Band squeeze. It's a real basic trading technique, but whenever you can find an asset with the bands very, very tight together for a long period of time, you know sooner or later that low volatility is going to revert to a high volatility, and waiting for the price to break out and push that band up or down would give you an entry to a trade because it signals the start or the end of trends. So as you can see, Bollinger Bands can be very useful by themselves, but remember too that they can also be combined with other indicators. And that's going to show, I put together a little video presentation because I tried to show this in class or do this in class, and it's virtually impossible for me to do it in a live presentation. So it's easier to record it and share it with you. So here we're going to combine Bollinger Bands with RSI and stochastic and MACD and use it together to build a strategy. So let me share that with you, and you can enjoy it for a minute. You basically will be watching it. So here we go.
Indicator 1, RSI. The Relative Strength Index compares the magnitude of recent gains to recent losses in an attempt to determine overbought and oversold conditions of an instrument. As you can see from the chart, the RSI ranges from 0 to 100. An instrument is deemed to be overbought once the RSI approaches the 70 level, meaning that it may be getting overvalued and is a good candidate for a pullback or reversal. Likewise, if the RSI approaches 30, it is an indication that the instrument may be getting oversold and therefore likely to reverse. Traders will often use the RSI either coming back out of its overbought or oversold areas as a signal or partial signal to enter a trade. As we can see, the RSI is often accurate when indicating when a market will reverse. A trader using RSI should be aware that large rallies and drops in the price of an instrument will affect the RSI by potentially creating false buy or sell signals. Traders often combine the RSI with other indicator signals, such as MACD crosses. Indicator 2. MACD. The moving average convergence divergence is one of the most well-known and used indicators in technical analysis. This indicator is made up of two exponential moving averages which help measure momentum in an instrument. These moving averages and the changing distances between them become the MACD. Convergence simply means the moving averages are moving close together, and divergence simply means they are moving away from one another. When the shorter-term moving average is above the longer-term moving average, this area of the indicator will show activity. When the shorter-term moving average is below the longer-term moving average, this area of the indicator will show activity. The center line, of which the MACD is plotted around, indicates where the moving averages are equal, and when the MACD passes through the center line, this indicates the moving average is crossing. The signal line, here in red, is a moving average of the MACD values themselves. Typical values for the MACD are 26 and 12 exponential moving averages, and 9 for the signal line. The farther apart the moving average is, and the greater the momentum, the farther away the MACD will be from the center line. Traders use MACD and signal line crosses, such as these, to indicate momentum trades. You can see how these crosses often match up with market moves. Traders also use the MACD crosses to indicate when momentum is coming out of the market, and may use it as a signal to exit a trade. Indicator 3. Bollinger Bands. A Bollinger Band starts off with a simple moving average. It then has two standard deviations plotted away from it. That sounds a mouthful, but the important part is because standard deviation is a measure of volatility, Bollinger Bands adjust themselves to current market conditions. When the markets become more volatile, the bands widen, move further away from the average, and during less volatile periods, the bands contract, moving closer to the average. The tightening of the bands is often used by technical traders as an early indication that volatility is about to rapidly increase, as volatility often follows periods of lack of volatility. The markets spend most of the time within the bands, and when the price action reaches the edge of the bands, it is often more likely to reverse and come back into the range. This is used as a signal by reversal traders to take a trade. This is similar to the oversold and overbought conditions of the RSI. Indicator 4. Super Trend Indicator. The Super Trend Indicator is an excellent indicator of trend direction. It can be used as a foundation of a trading system that is based on trend following. One of the most popular ways to use this indicator is to enter the market after a pullback. For example, if the market is on a downtrend, indicated by red, wait for a green pullback and then re-enter the market once it turns red again. The same can apply in uptrending markets. Here we can see how this indicator accurately tracks market trends. It can be refined through the settings to match the specific instrument. Indicator 5. Confluence. The last indicator isn't a new one, it's indicator confluence, which means to use multiple indicators and their signals to take a trade. Here we have the RSI and MACD we looked at. We have the RSI moving into overbought territory here. Remember that indicates the market will reverse. However, we want to help us filter out false signals on the RSI, so we also look at the MACD to give us confluence. We can see it is indicating the momentum has come out of the market, as far as the market rallying or going up is concerned, and we have an MACD cross here. A signal to enter this short trade could be waiting for the RSI to come back out of the overbought and also waiting for the MACD cross. We can see that those combined signals are an indication that captures this trend. We can also use the opposite signals to indicate when the momentum is coming out of the market and it's more likely to reverse and the market to retrace back up the opposite direction of our trade, and therefore is an exit signal. In addition to the RSI and MACD signals, we can add further confluence to this trade with a Bollinger Band and the Super Trend Indicator. We can see the market has hit the top of the Bollinger Band here, but we could also wait for the Super Trend Indicator to change red here before taking the short trade. So now we have the confluence of four indications. We have an RSI coming back out of overbought, we have an MACD cross, we have the market going to the edge of one of the deviations on the Bollinger Band, and we also have the super trend turning back to red.
So now we saw how to combine 4 indicators, but technically 3 indicators, into a trading system. Now, multicollinearity is very, very important. Too many traders use repetitive indicators that give you the same piece of information, and they kind of compete with each other. And you'll find that if you're using too many indicators to give you overbought and oversold, you're going to pick the one each time that's giving you the answer you want at the moment. Whereas if you were to combine Bollinger Bands, which works much differently than RSI, which works differently than MACD, the 3 will either support the market or support your trade decision or go against your trade decision. But they're not going to give you the same pieces of information. And Bollinger Bands is very nice because it's one of the few indicators, as I mentioned earlier in this class, that you actually drop over price. And it works extremely well when you combine it with other indicators that support. So Bollinger Bands are a great indicator to use in any market. When you combine these with like the RSI indicator, it could give you many signals for entry points. Something else you should consider is when price touches the middle band, you can make a second entry. The middle band is the moving average. Keep in mind at all times, the Bollinger Bands confirms the trend reversal, the trend continuation by breaking that moving average. So if you have any questions, please feel free to write them in. And I promise you somebody will send you an answer. And again, thank you for supporting Alvexo. And we'll talk to you again. I hope you learned something tonight and have a great trading week. Bye now.